Welcome to The Explainer. Today, we are tackling a really big question for any investor looking at the banking sector: the relationship between interest rates and bank profits. Now, it can seem pretty confusing, but trust me, getting a handle on this is one of the most powerful tools you can possibly have in your toolkit. So here's the central puzzle, isn't it? The central bank raises interest rates, and you see some bank stocks just take off, while others get hammered. What's going on there? Well, it's not random. There's a clear logic behind it, and that is exactly what we're going to solve together today. And by the end of this, my goal is to give you that why. We're going to build a mental model, a real playbook that you can use to size up any bank, no matter what's happening with interest rates. All right, let's jump right in. To solve our puzzle, we've got to start right at the heart of it all: how a bank actually makes its money. And you know what? It's not nearly as complex as you might think. In fact, you can boil almost all of it down to just one crucial metric. And that metric is called the net interest margin, or NIM for short. The easiest way to think about it is just as a bank's core profit margin. It's simply the spread between what it earns on all the money it lends out and what it has to pay people like you and me for all the money we deposit with them. Let's just break that down a little more. So on one side of the equation, you have what the bank earns on its assets, things like mortgages and business loans. We'll call that its loan yield. And on the other side, you've got what it has to pay out on its liabilities. That's the interest on our savings accounts. We'll call that its deposit cost. That gap, that spread between the two, that's the magic number. Okay, so if it's just a simple spread, why all the drama when interest rates start moving around? Well, that brings us to this fundamental tension that's baked right into the banking business model. You could call it the great mismatch. So here's the root of it all. A bank borrows money from us, the depositors, on a very short-term basis. I mean, you and I can go and pull our money out tomorrow, right? But the bank turns around and lends that same money out for the very long term. Think of a 20 or 30-year home loan. This mismatch in timing is exactly why banks are so incredibly sensitive to shifts in interest rates. So who actually wins when rates start to climb? It's the banks that have this very specific DNA. They have a high percentage of floating rate loans, which means their loan income resets higher almost right away. And they have a strong CASA franchise. CASA just stands for current and savings accounts. This gives them a huge, stable pool of very cheap money because the interest they pay on our checking accounts goes up way slower than market rates. So their income shoots up fast while their costs creep up slowly. That is the winning formula. Now, on the flip side, some banks face some pretty serious headwinds. If their loan book is full of old fixed-rate loans, their income is basically stuck in the past. But their funding costs are rising right now, especially if they rely on what's called wholesale funding. That's borrowing from other big financial institutions at market rates. So you see, their profit margin, their NIM, gets squeezed from both sides. This is the profile of a bank that's going to struggle. All right, so that's the theory. We've got the concepts down. Now let's zoom back out and see how this all translates into real-world performance. Let's look at the actual data and see how different kinds of banks perform as they move through these inevitable interest rate cycles. You see, interest rates move in pretty predictable cycles. You've got the rising phase, like we've seen recently, where central banks are fighting inflation. Then you hit a peak, then rates start to fall to get the economy going again, and finally, they bottom out at a trough. This whole thing usually plays out over 3 to 7 years. And as for right now, most analysts would agree we're somewhere near that peak, getting ready for the next phase. What's so fascinating about this is just how predictably different types of banks behave in each phase. You can see here the large private banks, with their big funding advantages, tend to do really well when rates are rising. But check this out. The mid-tier and small finance banks, they often struggle when rates are rising, but they can really outperform when rates start to fall. Lower borrowing costs just turbocharge their growth. And look, this is not just some academic theory. This is real-world results. During the recent rate hiking cycle, from roughly 2022 to 2024, banks that were focused on corporate lending, the ones that fit our winning formula we talked about, outperformed the rest of the banking sector by a solid 10 to 15%. This is the playbook in action. So we've built the model. We've looked at the proof in the real world. Now for the final and most important piece. Let's put this all together into an actionable investment strategy. This is where we turn all this analysis into a concrete plan you can actually use. Here it is, a simple 3-step process for positioning yourself early in a rising rate cycle. Step 1, you read the signals. You're watching inflation numbers and listening to what the central bank is saying. Step 2, you use the framework we just built to identify the banks with those winning characteristics. And step 3, you position your portfolio before everyone else catches on and the hikes are already priced in. To do that, you basically need your own little dashboard of key things to watch. You're tracking inflation for sure. You're paying close attention to the central bank's guidance. You're looking at a bank's quarterly NIM trends to see if they're actually walking the talk. And this one's really important. You're watching the yield curve. The yield curve can often tell you where rates are headed long before they actually move.
And the great thing is, this playbook works for every single part of the cycle. So let's just imagine for a second we see clear signs that rates are about to start falling. Well, your allocation would totally shift. As you can see here, you'd start to overweight those mid-tier and small finance banks that thrive on growth, and maybe add in a few other companies that do well when borrowing costs are cheap. You're just rotating into the companies that are set to thrive in a lower rate world.
And honestly, if you only remember one thing from our entire discussion today, please let it be this. The market is always looking ahead. The real money, the real advantage, comes from positioning your portfolio 6 to 12 months before an expected rate change happens, not after the fact when everyone else is piling in. And that brings us right back to today. We know the interest rate cycle is shifting. It's at an inflection point. The winners of the last 2 years might not be the winners of the next 2. So the question I want to leave you with is this. Now that you have the playbook, how will you use it?